You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Welcome to the Deep Dive. This is where we dig into your sources, your notes, all that research, and pull out the key insights for you. Today, we're jumping into exchange-traded funds, ETFs, specifically those really efficient, low-fee ones that can honestly make a huge difference to your financial future. I was talking to a friend just the other day, actually. She was pretty happy with her investment returns until we looked really closely at her mutual fund statements. She was paying over 1% in fees.
Wow. Yeah, that's high for a fund these days.
Right. And when we actually plugged that into a long-term calculator, her jaw just dropped. Seriously. We figured out it could mean hundreds of thousands of dollars basically just vanishing into fees over like 30 years.
Yeah.
It was a real wake-up call, a stark reminder of how much those, seemingly tiny percentages can eat away at your wealth. So for this deep dive, our mission is pretty clear. We're going to unpack why these little fees matter so much. We'll figure out what really defines a low-fee ETF right now in today's market. And then the really important part, we'll zero in on some top picks, the kind of funds that can be the backbone of your portfolio. So whether you're just starting your investment journey or maybe you've been doing this for years, I think you'll find some really actionable stuff here. Okay, let's just dive straight in. The big question, the one I hear all the time, even though it seems obvious. Why do fees matter so much? I mean, what's the real difference between paying, say, 0.5% versus 0.05%? It doesn't have a
Sounds negligible.
It really does. It's easy to just dismiss it. But, well, wrong. The numbers tell a completely different story, a story that can cost you big time. Okay, imagine this scenario. You start with, say, $10,000.
Okay.
And then you're diligent. You add $500 every single month for 30 years.
Right. Consistent saving.
Exactly. And let's assume a 7% annual return. Pretty standard long-term average for stocks.
Yep. Reasonable assumption.
Okay. So if you paid absolutely zero fees, which, isn't realistic, but just for comparison, you'd end up with around $739,000.
Okay. Nice chunk of change.
Now let's add those fees back in.
Yeah.
Even just 0.05% a year. Tiny. Right?
Seems tiny.
Your total drops to about $727,000.
Okay.
Not a huge hit yet. But bump that fee up to 0.5%, still less than 1%. Now you're looking at about $651,000.
Starting to see a bigger gap there.
And now let's go to that 1% fee my friend was paying, your final amount. It dwindles down to around $580,000.
Yeah.
That's a staggering difference. Nearly $160,000 just gone between the lowest and highest fee examples.
That's incredible. $160,000.
It's not just, extra vacation money that could be a down payment on a house, college tuition, a massive boost to retirement. This is what we call fee drag. It's like this silent killer of wealth that just works against you, compounding year after year after year.
And unlike market ups and downs, which you can't control, fees are guaranteed. They come out every single year, no matter what the market does. It's a guaranteed deduction from your potential returns.
Exactly. So, okay, we know fees are bad. Why are ETFs usually so much cheaper? What's the magic there?
Well, it's actually pretty straightforward. An ETF, an exchange-traded fund, is basically, like you said, a basket, a collection of securities, stocks, bonds, whatever. And the key thing is it trades on a stock exchange, just like a single share of, say, Apple or Google.
Okay.
So when you buy just one share of an ETF, you instantly own a tiny slice of maybe hundreds, even thousands of different companies or bonds.
Instant diversification.
Exactly. And the main reason they're cheaper usually comes down to how they're managed. Most ETFs are passively managed, meaning they're not trying to be clever and beat the market. They're just designed to track a specific market index, like the S&P 500 or a total bond market index.
Okay. So no expensive fund manager trying to pick winners.
Precisely. That passive approach, it gets rid of the need for, big, expensive research teams, tons of analysts, frequent trading, which itself costs money, and even high marketing budgets that many active funds have.
So it's just leaner. More automated.
Yeah, it's a much more efficient way to get that broad market exposure, much lower overhead.
So the main fee number we're usually looking at is the expense ratio. Yeah. That annual percentage cut.
That's the big one. Yep, the expense ratio.
And it's just wild how low that can be for ETFs. Like you gave the example, $10,000 invested in an ETF with a 0.03% expense ratio. That's $3 a year.
$3.
Compare that to, say, an actively managed fund charging 1.2%. that same $10,000 costs you $120 a year.
That's $117 difference right there on just 10 grand.
It really hammers home that fee drag point, doesn't it?
It really does. And while the expense ratio is definitely the most important cost to watch for, full transparency, it's worth knowing about a couple of other, usually smaller costs too.
Okay, like what?
Well, there's something called the bid-ask spread. It's that tiny difference between the price someone's willing to buy the ETF for and the price someone's willing to sell it for.
Like when you exchange currency at the airport, there's always that little gap.
Exactly like that. Now, for the big, popular, really liquid ETFs we're mostly talking about today, this spread is usually tiny, pennies or fractions of pennies, but it exists.
Okay.
The other one is tracking error. This is basically how well the ETF actually tracks the index it's supposed to follow. So if your S&P 500 ETF only returns 8% in a year when the actual S&P 500 index returned 10%, well, that 2% difference, that's tracking error.
And that obviously eats into your return, just like a fee would.
Precisely. But again, for the well-run, low-fee ETFs from the big, reputable providers, tracking error is typically very, very minimal. But still, it's good for you to be aware these things exist.
Definitely. Okay, so low fees are absolutely crucial. We've nailed that down. Right. But with like thousands of ETFs out there, how do you pick? Because like you said, the absolute cheapest one isn't automatically the best one.
Right. There's more to it than just that single number.
So when we say low fee today, what are we actually talking about? What's the ballpark?
Yeah, good question. In today's market, I'd say anything under 0.20% annually is pretty reasonable.
Okay.
If you can get under 0.10%, that's definitely good. And when you dip below 0.05%, that's excellent territory. And like you mentioned, some of the absolute best ones really do hit that incredible 0.03% mark.
Amazing. But beyond that expense ratio, what else makes an ETF truly great? What should people look for?
Okay, several key things.
Sure.
First, looking at assets under management, or AUM.
How much money is actually in the fund?
Exactly. Generally, you want to see a decent amount. I'd say at least $100 million, but preferably, over $1 billion.
Why does that matter so much?
Well, larger ETFs tend to be more stable. They benefit from economies of scale, making them more cost-efficient to run. They're also much less likely to just get shut down by the provider.
Oh, wow. I hadn't thought of that. A fund just disappearing.
It happens, especially with smaller, more niche ETFs. And if it closes, you're forced to sell, maybe at a bad time. Plus, bigger AUM usually means better liquidity. Easier to buy and sell without affecting the price much.
Okay, AUM. Got it. What's next?
Second, that tracking error we just talked about. You want an ETF that hugs its index really tightly. If it consistently lags behind, even by a tiny bit, that can kind of cancel out the benefit of a super low fee over time.
Right, makes sense. Precision matters.
Third, liquidity and trading volume. This ties back to AUM. Basically, how easy is it to buy and sell shares? High daily trading volume is usually a good sign of healthy liquidity. You don't want to get stuck trying to sell.
Okay.
Fourth, think about the provider reputation. Is the ETF from a well-known, established company?
Like Vanguard, iShares, Schwab, Fidelity.
Yeah.
Those big names.
Exactly. Those guys have the resources, the expertise, the infrastructure to manage these massive funds reliably. Generally, it's safer to stick with them.
Good advice.
And finally, and this is crucial, always look at the holdings and diversification. What does the ETF actually own?
Dig under the hood?
Yeah. How many stocks or bonds are in there? Are they concentrated in just one or two sectors like tech? Or one region? Make sure it actually matches what you think you're buying and aligns with your overall goals.
Oh, such a great point. Don't just assume total market means what you think it means. Look inside.
Absolutely.
So it sounds like the takeaway is don't just chase the lowest expense ratio. It's super important, probably the most important single factor for similar funds. But you got to look at the whole picture. A slightly higher fee, maybe 0.05% instead of 0.03%, might be totally fine if the fund tracks perfectly and has huge AUM and great liquidity.
Exactly. It's context. But generally, yeah, for two otherwise identical funds, lower cost wins. And maybe one more point, connecting back to your wallet, especially if you're investing outside of a retirement account, like in a regular brokerage account.
Yeah.
Tax efficiency. This is another area where ETFs, particularly broad index ETFs, really shine compared to many traditional mutual funds.
How so?
Without getting too technical, the way ETFs are structured allows them to manage their buying and selling in a way that tends to generate fewer taxable capital gains distributions for you, the shareholder.
Ah, okay. So less of a tax bite each year.
Potentially, yes. It's kind of like they have this built-in smart tax management feature. It's a subtle benefit, but over many years, especially in a taxable account, it can make a real difference.
Good to know. Okay, I think we've laid the groundwork. This is the fun part now, the actual funds. Where should people start looking? What are some of the champs?
Let's do it.
Let's start with the absolute core, right?
Yeah.
Total U.S. stock market ETFs. If you want to own basically the entire U.S. stock market, what's the go-to?
For me, the classic top pick is the Vanguard Total Stock Market ETF. Ticker is VTI.
VTI.
The expense ratio is an incredible 0.03%, and it holds something like over 4,000 U.S. stocks.
Well, 4,000. So everything from the Apples and Microsofts down to tiny companies.
Pretty much. Large cap, mid cap, small cap, it's all in there, weighted by market size. It's really the ultimate in simplicity and completeness for U.S. stocks.
And are there good alternatives if someone doesn't use Vanguard?
Oh, yeah. Schwab's U.S. Broad Market ETF, ticker SCHB, is essentially identical, also 0.03%. Basically interchangeable.
Okay, VTI or SCHB for the whole U.S. market. What about just the big guys, the S&P 500 ETFs? Those are super popular.
Hugely popular. And you often hear about SPY, right? The SPDR S&P 500 ETF Trust.
Yeah, that's like the original one, isn't it?
It is, but here's where fees bite you again. SPY charges 0.09%.
Which isn't awful, but...
But why pay that when you can get the exact same S&P 500 exposure for much less? Vanguard's VOO, ticker VOO, is 0.03%. iShares IVV, ticker IVV, also 0.03%.
And those are massive funds, right? VOO and IVV.
Absolutely huge. AOO has something like $450 billion in assets. IVV is even bigger, over $500 billion. Rock solid choices. You really can't go wrong with either.
And wasn't there an even cheaper one?
If you really want to pinch pennies, Schwab's S&P 500 offering, ticker SPLG, comes in at just 0.02%.
0.02. Amazing. It shows how competitive this space is. Even those tiny differences add up over 30 years, like we calculated.
They really do. And speaking of diversification, let's not forget the rest of the world. International diversification is so important.
Right. Don't put all your eggs in the U.S. basket.
Exactly. So for developed markets outside the U.S., think Europe, Japan, Australia, places like that. Vanguard FTSE Developed Markets ETF, ticker VEA, is excellent, only 0.05%.
VEA. Okay, how does that compare to others?
Well, the big iShares one, EFA, is way more expensive at 0.35%. So VEA is kind of a no-brainer there from a cost perspective. Schwab also has a great option, SCHF, at 0.06%. Very competitive.
So VEA or SCHF for developed international. What if you want emerging markets too, like China, India?
Good question. You could go for a broader international fund that includes both developed and emerging markets. Vanguard's Total International Stock ETF, ticker VXUS, does that. It's 0.08%.
VXUS.
Yeah.
Covers everything non-U.S.
Pretty much. Or if you specifically want to overweight or just target those faster-growing emerging economies, Vanguard has VWO, the FTSE Emerging Markets ETF, at 0.10%.
VWO for emerging.
Yep. And its iShares competitor, IMG, is very similar at 0.11%, also a solid choice.
Okay, wow. That gives people a lot of great building blocks. And, thinking about simplicity, you could actually get pretty much the entire world stock market with just two funds, couldn't you?
Right.
Like VTI for the U.S. and VXUS for international.
Absolutely. That's a fantastic, super simple, low-cost global portfolio right there. VTI and VXUS. Done.
Or, even simpler, isn't there one fund that does it all?
There is. For the absolute ultimate in simplicity, Vanguard's Total World Stock ETF, ticker VT.
VT.
Expense ratio is 0.08%. And it holds stocks from all over the globe, developed and emerging, basically weighted by their size in the world market.
So it's roughly like 60% U.S., 40% international, all in one package.
Exactly. It adjusts automatically. It's a fantastic one-stop shop if you just want global stock exposure without having to manage multiple funds.
That's incredibly powerful. Okay, we've covered stocks extensively. Let's switch gears to the other vital part of a balanced portfolio. Bonds.
Right. The less glamorous but oh so important part.
Exactly. Stocks get the headlines, but bonds provide that stability, they reduce the bumps, and they generate income. So what's the VTI equivalent for bonds, the big, broad market option?
The go-to is usually the Vanguard Total Bond Market ETF. ticker BND.
BND. Oh.
Expense ratio, again, incredibly low, 0.03%. And it holds, get this, over 10,000 different U.S. bonds.
Yeah, 1,000. So government bonds, corporate bonds.
Yep. Government, high-quality corporate bonds, even mortgage-backed securities. It's a huge slice of the entire U.S. investment-grade bond market. Super diversified, super low cost.
Yeah, and alternatives.
Schwab's SCHZ and iShares AGG are pretty much identical. Also 0.03%. All excellent choices for core U.S. bond exposure.
Great. Now, what if someone wants just the safest possible bonds, like U.S. government debt, Treasury ETFs?
Yep. Treasuries are considered among the safest investments in the world. For intermediate-term treasuries, often a good balance between yield and interest rate sensitivity. Vanguard's VGIT is great at 0.05%.
VGIT.
And for longer-term treasuries, if you want that exposure, Vanguard has VGLT, also at 0.05%. You definitely want to watch fees here. Some other treasury ETFs can be quite a bit pricier.
Good tip. Always check the fee.
Always. Now, something else that's become really relevant, especially when inflation picks up, are TIPS, Treasury Inflation Protected Securities.
Ah, yes, the ones that adjust for inflation.
Exactly. Their principal value goes up with inflation, helping protect your purchasing power. For short-term tips, Vanguard's VTIP is excellent at 0.04%. And Schwab's SCHP is also fantastic, also 0.04%. Really good low-cost options for that specific inflation protection.
Nice. What about corporate bonds, if you want a bit more yield?
You can get that with corporate bond ETFs, but remember, higher potential yield usually comes with a bit more risk than treasuries.
Right. Companies can default. The government.
Yeah.
Less likely.
Much less likely. But for investment-grade corporates, Vanguard's intermediate-term corporate bond ETF, ticker VCIT, is a solid choice at just 0.04%.
VCIT. Okay. And international bonds. Do people need those too?
They can add another layer of diversification plus some currency exposure. Vanguard's Total International Bond ETF, BNDX, covers developed markets outside the U.S. for 0.07%.
BNDX. Got it.
It gives you exposure to foreign interest rates and currencies, which can sometimes move differently than U.S. rates.
Okay, that's a comprehensive look at bonds. And, something that often trips people up with bonds, especially newer investors, is that relationship between interest rates and bond prices. When rates go up, the price of existing bonds and bond ETFs tends to go down.
Absolutely. That inverse relationship is key to understand.
And seeing your bond fund value drop can be scary if you don't expect it. People think my bonds are losing money.
Right. But it's crucial to remember that's a normal market function. It doesn't mean the underlying bonds are bad or going bust. You're still collecting the interest payments.
Right.
And the fund holds thousands of bonds, maturing at different times, reinvesting at potentially higher rates. It's not a reason to panic, sell your bond fund. It's just how bond math works.
Such an important point. Don't panic when rates rise. So for most people, keeping the bond side simple is probably best, right? Like maybe just BND for the core U.S. stuff.
I think so. BND is a fantastic core holding. Maybe add some VTIP if inflation is a major worry for you, and potentially BNDX if you want that international diversification. But you don't need to get super complicated on the bond side usually.
Keep it simple. Okay, so we've got our core stock and bond building blocks. What about adding some flavor, those specialized ETFs?
Yeah, the enhancers. These aren't necessarily replacements for your core VTI or BND, but they can help you tilt your portfolio towards specific goals or themes.
Like income, right. People love dividends. What are the options for dividend-focused ETFs?
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
Lots of good low-cost ones now. Vanguard has VIG, the Dividend Appreciation ETF, at 0.06%. It focuses on companies with a solid history of increasing their dividends year after year.
So quality growth companies that also pay dividends.
Exactly. Then there's VYM, Vanguard's High Dividend Yield ETF, also 0.06%. This one targets companies paying higher than average dividends right now, more focused on current income.
VBA TIRE for growth, VYM for current yield.
Okay. And another really popular one is Schwab's SCHD, the U.S. Dividend Equity ETF, also 0.06%. People like it because it combines that dividend focus with some quality screens looking for financially healthy companies.
SCHD. Heard a lot about that one. Okay, what about real estate? REITs.
Yeah, real estate investment trusts. They can be a good diversifier, potentially offer some inflation protection since rents can rise. Vanguard's VNQ is the big one, 0.12%.
VNQ.
And Schwab's SCHH is a bit cheaper at 0.07%. Both give you broad exposure to U.S. REITs across different property types, offices, apartments, malls, etc.
Good diversifier.
Yeah.
And what if you want to bet on a specific sector, like tech or healthcare? Sector ETFs.
Yeah, there are low-cost options for almost every sector now.
Examples.
For technology, Vanguard's VKT is 0.10%, or the SPDR fund XLK is 0.109%. For healthcare, Vanguard's VHT is 0.10%, SPDR's XLV is 0.09%. For financials, Vanguard's VFH is 0.10%, SPDR's XLF is 0.10%. You see the pattern usually around 0.10% or just under.
So you can definitely target specific areas if you have a strong conviction.
You absolutely can. And going beyond sectors, you can even get into factor-based ETFs.
Factors.
Yeah.
Like value or growth.
Exactly. Factor investing means deliberately tilting towards characteristics or factors that historically have been linked to better returns or maybe lower risk.
No examples.
Vanguard has VTV, the value ETF, at 0.04%, and VUG, the growth ETF, also 0.04%. Or you could combine factors like with VDR, Vanguard's small cap value ETF, at 0.07%, trying to capture both the small size premium and the value premium.
Interesting. Getting a bit more complex there.
It is. And then there's the whole world of ESG ETFs, environmental, social governance.
Like social responsible investing, that's gotten huge.
Huge. And costs have really come down. Vanguard has ESGV, an ESG US stock ETF, for just 0.09%.
ESGV.
iShares has DSI, which tracks a long-standing social index, the KLD 400. It's a bit pricier at 0.25%, but stay reasonable for that kind of specialized screening.
Okay. And one more category, this set it and forget it option.
Yes. Target date ETFs. These are basically designed to be a complete portfolio in one single fund.
How do they work?
You pick the fund with the date closest to your planned retirement year, say a 2050 fund. It starts out heavily weighted towards stocks and then automatically gradually shifts more towards bonds as you get closer to 2050.
So it manages the allocation glide path for you.
Exactly.
Yeah.
Super simple. Vanguard's target date ETFs are excellent, typically around 0.08% expense ratio, makes investing incredibly hands-off.
That sounds great for someone who really doesn't want to tinker.
Yeah.
But a word of caution on all these specialized funds.
Yes, definitely.
They should generally complement your core holdings, right? Not be your core holdings.
That's the key advice. Think of them as satellites around your core VTI or VT and BND. Maybe keep them to, say, 20%, maybe 30% max of your total portfolio.
And avoid those super niche ones, like an ETF for just one tiny industry.
I would. Even if they're cheap, those ultra-narrow ETFs can be really volatile and risky. If that one theme or industry goes sour, you could get hammered. Broader is generally better for the core.
Got it. Less is often more. Okay, let's bring it all together. We know the what's and the why. Now, how do you actually build a portfolio with these things? This is where the rubber meets the road.
Right. Putting theory into practice.
For someone just starting out or anyone who loves simplicity, that 3-fund portfolio seems ideal, doesn't it?
It's a fantastic, elegant solution. Covers the whole world, super cheap.
So walk us through a typical allocation again.
Sure. A common starting point might be 60% in a total U.S. stock market ETF, like VTI.
Okay, 60% U.S. stocks.
Then maybe 30% in a total international stock market ETF, like VXUS.
30% international stocks. Got the world covered.
Yep. And the remaining 10% in a total U.S. bond market ETF, like BND.
10% bonds for stability, so 6RT010.
Exactly. That gives you broad global diversification, the total cost. Probably around 0.05% or even less, depending on the exact funds. Incredibly efficient.
And as you get older, closer to needing the money.
You typically dial back the stocks and increase the bonds, maybe shift towards 20% or 30% bonds or even more, depending on your situation.
Makes sense. What about a slightly more complex version, maybe adding a bit more granularity?
Sure, you can do a 5-fund portfolio for a bit more control, maybe something like 40% VTI, U.S. stocks.
Okay, dial back the U.S. a bit.
20% VXUS, international developed, keep that. But then add 10% specifically in VWO, emerging markets.
Giving emerging markets their own slice.
Right. Then maybe 20% in VND, U.S. bonds.
Upping the bonds slightly.
And the last 10% in VNQ, real estate REITs, for that extra diversification and inflation hedge.
Okay, so 40, 20, 10 stocks, 20 bonds, 10 REITs. Still pretty simple, but a bit more tailored.
Exactly. Gives you a few more levers to pull if you want them.
Now, how do people decide on that core stock-bond split? You mentioned maybe increasing bonds with age.
Yeah, the classic rule of thumb you often hear is hold your age in bonds.
So 30 years old, 30% bonds, 70% stocks. 50 years old, 50-50.
That's the idea. But honestly, it's just a starting point, a very rough guideline.
Right, because everyone's different.
Totally. Your personal risk tolerance, how much sleep you lose when the market drops, is way more important, and your specific retirement timeline and goals matter more than just your birth year.
Good clarification. It's personal. Okay, so you've picked your funds, decided your allocation. What are the practical steps to actually doing it and keeping it going?
Okay, number one strategy, arguably the most powerful, dollar cost averaging.
Meaning investing the same amount regularly, no matter what.
Exactly. Put in, say, $500 every month, whether the market just soared or just crashed. Buy high, buy low, buy in the middle.
Takes the guesswork out. And the emotion.
Precisely. It smooths out volatility. You automatically buy more shares when prices are low, fewer when they're high. And it stops you from trying to time the market, which, as we'll discuss, is usually a bad idea.
And brokerages make this easy now, right? Automatic investing.
Super easy. Most let you set it up like an automatic bill payment. Pay yourself first, right into your ETFs. Effortless wealth building.
Love it. What else? What happens when the market moves your allocations around?
That's where rebalancing comes in. Your 60% stock allocation might grow to 70% after a good run, right? Rebalancing just means bringing things back into line with your targets, selling some of the winners, stocks in this case, and buying more of the laggards, maybe bonds, to get back to 60-40 or whatever your target is.
How often should you do that?
There's no single right answer. Some do it quarterly, some semi-annually, some just once a year. Others rebalance only when an asset class drifts too far, say more than 5% away from its target.
So the key is just having a plan.
Having a plan and sticking to it. Don't just do it randomly.
And here's that practical tip I liked. If you're adding new money regularly, you can often rebalance just by directing that new money towards whatever's underweight.
Right.
So stocks ran up and bonds are low, put your next $500 into the bond fund.
That's a brilliant, tax-efficient way to do it. You avoid potentially selling winners and triggering capital gains taxes while still nudging your portfolio back towards its target. Great tip.
Cool. And speaking of taxes, you mentioned ETFs are generally efficient. Any specific tax things to watch out for, especially in regular brokerage accounts?
Yeah, two main things. First, the good news. Broad market index ETFs like VTI, VXUS, VOO, very tax efficient usually because they don't trade much internally, low turnover, so they tend not to spit out a lot of taxable capital gains distributions each year.
Okay, that's the advantage we talked about.
Right, but the key warning, especially for taxable accounts, relates to bonds. The interest income you get from bond ETFs like BND or AGG, that's generally taxed as ordinary income at your regular income tax rate, not at the lower long-term capital gains rates that qualified stock dividends get.
So bond interest gets taxed higher than stock dividends in a taxable account.
Typically, yes. Which is why, if you have the choice, it often makes sense to hold your bond ETFs inside tax-advantaged accounts like your IRA or 401k, where that income can grow tax-deferred or tax-free. Put the less tax-efficient stuff, bonds, in the tax-sheltered accounts if you can.
That's a really valuable planning tip. Hold bonds in your IRA if possible. Okay, let's switch to the danger zone. What are the common mistakes people make with ETFs, and how do we avoid them?
All right, let's hit the pitfalls.
Mistake number one, I see this all the time. Chasing performance.
Oh, yeah, the classic. This fund was up 50% last year. I got to get in.
Right. But that fund might be focused on some narrow sector that's about to crash. Past performance, as they always say.
Does not guarantee future results. Absolutely.
Yeah.
Focus on your plan, low costs, broad diversification, not last year's lottery ticket.
Okay. Mistake two, over-diversification. Is that really a thing?
It totally is. I've seen people with like 25 different ETFs, a little bit of everything.
Thinking more is better.
Yeah, but often when you look under the hood, all those niche funds just end up recreating the total market anyway, but with more complexity and potentially higher average fees.
So basically buying VTI in 25 complicated steps.
Pretty much. Keep it simple. A few broad funds are often all you need. Don't collect ETF like baseball cards.
Good analogy. Okay, mistake three, ignoring international. The home country bias.
Huge mistake. It's so easy to just invest in what, the U.S. market, but you're missing out on diversification benefits.
Because sometimes international stocks will zig when U.S. stocks zag.
Exactly. And sometimes international outperforms the U.S. for years. Having global exposure smooths your ride and potentially improves long-term returns. Aim for at least, 20-30% international stocks. Don't put all your eggs in one geographic basket.
Solid advice. What's next on the mistake list?
Mistake number 4. trying to time the market, thinking you can jump out before a crash and jump back in before the recovery.
The siren song of market timing.
It sounds great, but it's a losing game. Even the pros can't do it consistently. You have to be right twice, when to get out A and D, when to get back in. Missing just a few of the best days in the market can devastate your long-term returns.
So the solution is just stay invested, dollar cost average.
Stick to your plan. Invest regularly. Ignore the noise. Time in the market, not timing the market.
Got it. Mistake number 5.
Focusing only on the expense ratio.
Wait, but we just spent half this deep dive saying fees are crucial.
They are crucial, probably the most important factor, but not the only factor. Remember tracking error. Liquidity.
Ah, right. The whole package.
Yeah. A fund charging 0.05% that tracks poorly might actually give you a worse net return than a fund charging 0.08% that tracks its index perfectly and is super easy to trade. Look beyond just the headline fee.
Context matters. Okay, mistake 6.
Not understanding what you actually own. Buying an ETF based on a hot tip or a cool name without really digging in.
Like buying that disruptive tech ETF without realizing it's 90% invested in just 5 stocks.
Exactly. You have to look under the hood, read the fund summary, check the top holdings, understand the strategy. Does it actually fit your goals and risk tolerance? Don't invest in black boxes.
So what you own, simple but vital. And the last big mistake, probably the most common.
Mistake number 7, panic selling. Letting fear take over when the market inevitably drops.
Seeing your balance go down 20% and hitting the sell button.
It's human nature, but it's usually the worst thing you can do. Market downturns are normal. They happen. Selling low just locks in your losses and means you miss the eventual recovery.
Easier said than done, though, staying calm in a crash.
It really is. But you have to remember your long-term plan. If anything, downturns are opportunities. You get to buy more shares of your great ETFs at clearance prices using dollar cost averaging. That's how real wealth is built over decades.
So embrace the downturns as buying opportunities.
If you can frame it that way, yes. And maybe my sort of golden rule for all this ETF investing.
Lay it on us.
Boring is beautiful.
Boring is beautiful.
Yeah. The most exciting stock story, the hottest new trend. That's rarely where the steady long-term profits are. Consistent investing in low-cost, broadly diversified, kind of boring ETFs, that lets compound interest work its magic. That's the beautiful part. It just works quietly in the background.
I love that. Boring is beautiful. Okay, people are convinced low-fee ETFs are the way. What are the immediate practical next steps?
Let's make it actionable.
Step 1, you need a place to buy these things, right? Choose your brokerage.
Yep. Good news is most major brokers, Fidelity, Schwab, Vanguard, others, now offer commission-free trading for most ETFs. So buying and selling doesn't cost extra.
What should you look for in a broker?
Besides commission-free ETFs, look for a reputable company, good customer service, an easy-to-use website or app, maybe some helpful research tools if you want them. Find one you feel comfortable with.
Okay, got your account open. Step 2.
Start simple. Please, start simple.
Don't try to build that complex 5-fund portfolio on day 1.
No, don't feel pressure to get fancy immediately. Just start with 1 or 2 really broad funds, maybe just VTI for U.S. stocks and BND for bonds, or even just VT for the whole world in one fund.
Keep it manageable at first.
Totally. You can always add complexity later once you understand the basics and feel more confident. Don't let complexity paralyze you from starting.
Great advice. Step 3. This one feels key.
Set up automatic investing. Automate it.
The dollar cost averaging engine.
Exactly. Decide how much you can comfortably invest each month or each payday, even if it's just $50 or $100, to start and set up that automatic transfer and investment into your chosen ETF.
Takes willpower out of the equation.
Completely. It just happens. Treat saving and investing like any other essential bill, probably the single most impactful habit you can build.
Okay, brokerage chosen, started simple, investing automatically. What next?
Step 4. Monitor, but don't obsess.
Don't check your account balance 3 times a day.
Please don't. That way lies madness. Check in maybe quarterly or semi-annually. See how things are tracking against your plan. Are your allocations drifting way off? Do you need to rebalance?
Focus on the long-term trend, not the daily blips.
Exactly. The daily market news is mostly just noise. Focus on your trajectory over years and decades.
Yeah, the final step. Maybe the hardest.
Step 5. Stay the course.
Resist the urge to tinker.
Resist. There will always be noise. Market crashes, recessions, political drama, new hot investments. Resist the urge to constantly change your strategy based on headlines or fear or greed.
Trust the plan. Trust the process.
Pretty much.
Yeah.
There's a lot of evidence suggesting the investors who achieve the best long-term results are often the ones who do the least. They set up a good plan and let it run.
Let boring be beautiful.
Let boring be beautiful.
It really is like a marathon, isn't it? Not a sprint. And these low-fee ETFs are like really good running shoes. They let you keep going comfortably for the long haul without tripping you up.
Perfect analogy. They remove the friction, the cost drag, the temptation to constantly switch shoes. They just let you run your race.
Okay, let's wrap this up with a quick recap. We hit a lot today. We learned just how massive the impact of seemingly tiny fees can be over decades. Hundreds of thousands of dollars, potentially.
Dag is real.
We dug into why ETFs are usually so cost-effective, that passive management structure, and what makes a great ETF beyond just the fee, AUM, tracking, liquidity provider.
The whole package.
We covered some absolute champion funds, broad market powerhouses like VTI, VOO for the US, VXUS for international, or just VT for the whole world.
The core building blocks.
The essential bond funds like BND for stability, maybe VTIP for inflation protection.
Don't forget bonds.
And those specialized options, VIG or SCHD for dividends, V&Q for real estate, sector funds if you want to tilt.
The enhancers, used carefully.
And we talk strategy building simple, effective portfolios like the 3-fund or 5-fund using dollar cost averaging and rebalancing.
Practical application.
So if we boil it all down, what are the 5 absolute key takeaways for someone listening?
Okay, 5 key rules. 1, keep costs low. Every fraction of a percent matters enormously over time. Fight for those basis points.
2,
stay diversified. Don't bet the farm on one country or one sector. Go global.
3,
keep it simple. Complexity is often the enemy of good returns.
Yeah.
You probably don't need 20 ETFs, maybe just 2 or 3, or even 1.
4,
invest regularly. Automate it. Time in the market beats timing the market every time.
and number 5.
Stay the course. Tune out the noise. Stick to your plan through thick and thin. Let boring be beautiful and let compounding do its magic.
Fantastic summary. Keep costs low, stay diversified, keep it simple, invest regularly, stay the course. Now, just the necessary disclaimer. Everything we've discussed today is for educational and informational purposes. It's not personalized investment advice.
Absolutely. Your situation is unique.
Right. So think about your own risk tolerance, your timeline, your goals. And if you're unsure, seriously consider talking to a qualified, fee-only financial advisor who has your best interests at heart.
Good advice.
Okay, that wraps up our deep dive into the power of low-fee ETFs. Until next time, keep investing smart, keep those costs down, and maybe mull this over. The best investment strategy isn't necessarily the most complex one or the one with the highest potential return on paper. It's the one you'll actually stick with.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.